be talking about the indecision strategy. Now, there are probably as many traders and trading strategies as there are traders, but not all trading strategies and trading plans are created equal. I suggest that you find some strategies and then build a trading plan around them. There's a plethora of trading strategies available to you, but I also encourage you to create your own strategies using these as your base. Like tonight, we're going to be talking about the indecision strategy. Now, we're going to be talking about also the reversal setup, but there's many different setups using the indecision candle strategy. The fact is, I couldn't, in a week of talking to you, get everything out of my head and into your head about executing this strategy. What I can do is show you the general steps, the process, give you an understanding and a foundation that you can then make it yours by practicing it, understanding it, and adding in all your own little sets of rules by you understanding this. Because if you just want to follow blindly all the rules I'm going to give you, you will eventually lose all of your money, because I can't give you all of my insight. I can't get it out of my head. So when you build and test your own strategy, you are the master and you understand all the ins and outs, and you are not just trying to duplicate someone else's thought process. Now, I always encourage traders to develop their own trading strategy, time permitting. There are several reasons why I believe it's important for traders to develop their own strategy. First, creating strategy requires you to develop a greater knowledge of the market and of price movement. See, too many, especially new traders, want to just do what I say. They would like me to give them not even just a set of rules, they'd like me to give them a set of steps, and they just want to do step 1, step 2, step 3, step 4, execute the trade, make money. Well, it doesn't work that way. I don't even have step. Now I have, because I've been trading the strategy all my life, and I have all of my notes and my cards and everything else, that I know what I'm looking for, but I also know the different types of markets. I know what's happening. I know how the different assets react. I can feel the price action on the chart. I can feel when this strategy is right. Okay, I can see it developing. I can see the trade. I can see it all in my head because I've been doing it for a long time. And too many traders want to not understand what price is trying to tell them. They just want to follow some rules. Now, secondly, when one develops their own trading strategy, they are tuned into how that strategy works, what will cause it not to work, and when they will be in a much better place to adjust it when needed. Now, even if you trade someone else's strategy, test it thoroughly, and in the process, make it your own as you learn the ins and outs, possibly even adding your own twist. Now, this may be the time-consuming part, but if you learn to appreciate it and understand it, you'll be surprised how well you do, because too many traders just want to execute trades. If you can get your enjoyment out of finding the best trade by filtering out, finding out and testing your strategies, so that when you get a successful one, the rewards are much deeper than just the money in your platform, then you're going to find out you enjoy this a lot more. Now, in short, you want to analyze your charts looking for opportunities. Examine those opportunities and construct how you turn those opportunities into real money without exposing yourself to risk. And this is the best way to find or adjust a strategy. Look on your charts and the assets you trade, and look for a movement, a past opportunity, not a tomorrow's opportunity. Look for an opportunity you missed, you didn't see, you didn't hear about, or you're looking at and say, look at that. If I would have traded that movement, I could have made myself 40 pips. And then figure out what you could have done to be alerted to that movement. And then filter all your inputs, test and modify, and make the strategy your own. But you don't need to reinvent the wheel. You also have to decide what you want out of your strategy. Do you want it just to give you trading signals or alerts? Do you want to give it entry points? What do you want it actually to do for you? How are you going to get all of these pieces? Because to execute a trade, you need a lot of pieces. So whether now, one of the most important things that you need to put on your charts to figure out your strategy, and especially for our indecision strategy, is support and resistance. Support and resistance are the floors above and below the current price that will let you know when something is happening. Now, forget the words support and resistance. Let's talk about being important price levels. Now, tonight, we don't have a great deal of time to talk about support and resistance because the understanding is most of you know how to draw support and resistance on your charts. So remember, support and resistance areas show where to look for buy and sells. They are a vital part to every trader's toolkit, and they are essential that you know how to place them. And they are a structural part of most strategies. And tonight's indecision candle strategy is very much dependent on support and resistance levels. Now, placing support and resistance areas is the most important skill you can master in trading. And placing them is easy. Support and resistance areas divide your chart into areas of buy and sell areas. An area that sits above the current price is a sell area. An area that sits below the current price is a buy area. These are historical prices where in the past, when the asset was trading around this price, it either had difficulty going up, it had difficulty coming down, or it hemmed and hawed there for a while. So if we call them price levels, as opposed to support and resistance, then you don't have to worry. When price is moving up and it got stuck at one, say at 1772 for gold, 1772 became a important price level. When gold continued up and it got stuck at 1899 or 1799, because 1800 was a very strong, at that point, resistance level, but it was an important price level because when gold goes up to 1805 or 1810, it starts coming back down, it's going to get stuck again at that 1800 level. So it's a price level, whether we're going up or down, that we should be looking at. Now, good traders don't randomly place entry orders and hope they get lucky. They place their entry orders at significant price levels. Significant price levels come in many forms. Now, there are lots of indicators out there that claim to give you support and resistance areas. We have pivot points, you have Fibonacci retracement levels, all this stuff. The only suggestion I have for any of my strategies is what I call eyeballing. That means looking at your charts and finding out where the price had stumbled or stuck in the past. Okay? And then drawing those lines, and those lines will automatically be put forward into the future. And every time the price gets to this area again, like I said, Bitcoin hit 40,000 this week. It's been down to 30. Well, when it started going up to 32, 34, 35, all those levels were already on your chart because Bitcoin's already gone through that price. So all of those levels just became valid again. And then when Bitcoin drops back down to 22, those levels around 22 that you had from the past are still valid, and they're automatically on your charts being pulled forward. Support and resistance placements still need to be done by a person. These are my support and resistance areas, but if you want to trade more pairs, you need to place them on yourself. But don't worry, it's easy. All you have doing is placing horizontal lines on a chart when you notice where prices bounced or stuck or hit a price more times in the past. Okay. So let me pop up a real chart here for you. Hold on a second. Okay, let's go to my teaching chart over here. We're going to get to, okay. See these lines? The horizontal lines. The one at 119.059, the one at 119.040. These are levels of support and resistance that this asset has gone to in the past, not currently, but previously back here. Now, the reason we have a thick blue line as opposed to a thin blue line down here is because the thick blue line, to me, and see, support and resistance are very personal. You can color them, make them whatever you want to do, make your own legends, and you can set your own levels. And this is what makes you better than the guy sitting next to you. But when I make a thick line, that tells me it was a major resistance line that's held through for a long time. When I have a thinner line, it tells me it was a minor, okay, or it's a more current level. So we can see in this particular asset, look how good this blue level held here. So when price was moving it and it hit there. Now we can see in this movement up, price stopped here for a minute. It went through, but look at all the times it stopped and hit that line. Okay. Now moving up here, look at that major resistance level, but price didn't even stop, didn't blink an eye. But look, then it fell, climbed back above and didn't blink an eye. So this line really, even though it's a key line and it's a correct line, didn't stop the asset, but it was a price level that we were looking for something to happen. Now, because nothing happens, not a bad thing. If you know a price and you're expecting a bounce off of 132.4 and it doesn't, it breaks right through and is moving an uptrend, that tells you that uptrend is very, very strong. So it tells you something about what you're looking at anyway. But there's never a guarantee that price is going to stop in either direction at these support and resistance lines. And there's no guarantee of what is going to happen. But they give you critical points along that path of the asset that something should happen or that it tells you something. You need to have some number to compare something to as price is moving up and down. Now, the next part of our piece of information that we have to have for our strategy, next piece of knowledge you have to have for your strategy is called candlestick analysis. Okay. Now, yes, I actually have a 3-week course on candlesticks. Okay. And I could go on teaching for months on candlesticks. Yes, you're not going to learn that tonight, but the thing is, most new traders learn a little bit about candlestick analysis, but most of what they learn is completely useless. Every new trader wants to tell you, oh, I know a bullish engulfing and bearish engulfing, and I can spot an evening star, a morning star. I can spot 3 black crows. I can do everything. Well, this is the standard approach to candlestick analysis, and it's really pattern recognition, which fails to work in real trading and doesn't work well for us at all in our type of short-term online trading. So, because you normally see a list of patterns like here, like the hammer, the inverter, and you're told when this appears on your chart in this way, do this, and do that. Okay. Again, that's like trading a strategy. Somebody's told you do this, do that, and do that. Now, this is not candlestick analysis. It's pattern recognition. And for a price action trader, it's useless. It's worse than useless. Thinking about candles as just patterns is counterproductive. It makes you a worse trader. It leads you to make mistakes. Why? Given a pattern, a set of definitions leads to tunnel vision. When you see that specific pattern, you assume that something will happen. But that's not how candlesticks work. All candlesticks need to be assessed based on the candlesticks around them and many other factors. So one person can see a spinning top and say that means a reversal is imminent. Another person can say that spinning top tells you it's just the trend is temporarily stalling. It can mean a lot of things. But if you're looking at your chart and building your strategy, you have your support and resistance on your chart, and you have your candlesticks moving across your chart. Now, every single candlestick is on your chart is telling you a story. It's telling you who's in control, the bulls or the bears. Now, tonight, we don't need to get involved in all of the stuff about candlesticks. We need to know one basic factor. Okay? Who is in control of the market and where is this indecision candle appearing? Now, when we say we're looking at a market move, like here, we're seeing 3 red candles. We're not looking for a trend line. We're looking for what or who was in control of the market in the short term. Well, these 3 red candles, and it could be 3 red candles, and that's for the ease of drawing, but it could be 4 red candles and 1 green candle. But it told you that price is moving steadily down in that period. And so the bears are in control because it's not ultimately important to us. But here, the candlesticks all closed lower than they opened. They all created new lows beyond the previous candle's low, and they all had small upper wicks. That's what's important, small upper wicks. That means the buyers were not able to drive price upward at all. They had long, not very long bodies, but longer bodies. So that meant that the bears were steadily pulling price down. So one would assume that the bears are in control. But we don't care. Because to us, the bears aren't in control, because when we get this little candle down here that appears after this bearish move, this is what we're looking for. And this is called an indecision candle. Now, indecision candle has very specifics. It's got a short upper wick, a small body, and a long lower wick. Now, that's only true in a downtrend. It's the exact opposite in an uptrend. So what is this telling us? That the bulls or the bears tried to push price down, but the bulls were able to maintain it and actually close a little higher, and they closed pretty close to the highest point they had. But the candle itself had a very small body. Small body candles tell you that you have indecisiveness in the markets. The long lower wick tells us the bears tried as much as they could, but guess what? The bulls woke up and fought back. Now, indecision candles occur all the time. You can't base a trading strategy on indecision candle, but it's a simple little candle to see. For our strategy, once we have our support and resistance on our chart, we're looking for a short-term uptrend or downtrend, a short-term movement where somebody for at least 3 candles or more is taking control of the markets. So in this case, we have 3 candles all closing higher, short lower wicks, nice long bodies. So we would look at that chart and say the bulls are in control. But then look at what we get. We get an indecision candle. Okay. That indecision candle, because this is coming off of an uptrend, is a red candle or a bearish session. It's got a small lower wick and a long upper wick. That's telling us because the bulls kept trying to pull up that session, pulled it up, but the bears woke up and they were able to pull it back down and close pretty close to the bottom or the low. Again, is that enough for us to execute a trade? Nope. Now, it comes down to where this happens. Now, when we get the indecision candle, whether it's coming off of a bearish trend or a bullish trend, and it develops directly on our support or resistance level, our price alert level, then it becomes strategically important, because that tells us our resistance or support area, depending whether we're moving up or down, is working. Now, that doesn't mean the next candle can't continue up in that bullish session and continue the uptrend. It doesn't mean in the opposite, in the downtrend, it's going to continue. Doesn't mean it's going to bounce off and come down low. Okay. Doesn't tell you anything except when it forms on an area of support or resistance, it's telling you that those levels are holding true, and there might might be an opportunity. So price stalls and we get indecision forming on top of that area. This tells us that the sell area is working. When price pushed into that area, sell orders triggered and buyers could no longer continue up. And that's the story of price in this chart. And that gives us a nice little price action trade setup. Now, price action allows us to take many different trade types: reversals, continuations, range, swings, breakouts, scalp trades, just to name a few. Now, tonight, the only thing we're going to be looking at is the reversal trade setup using these three issues. There are different interpretations for continuations, for range, for breakouts. Okay. But how do we spot a reversal trade? Reversals occur quite often, but if you don't know what to look for, you cannot trade them. Reversals are one of the strongest price action setups and one of the easiest to trade. And because they occur so often, you can trade this setup exclusively. You can limit yourself to just these kind of trades and have more than enough trades and become an expert at the indecision candle reverse trade setup. That's all you could trade. Now, reversal trades come in three parts: the preceding trend, the indecision candle, and the reversal trend. The preceding trend, we talked 3, 4, 5 candles showing a dominant move in one direction. The indecision candle, small body, long upper, lower wicks, depending on which way we're going, forming directly on, not before, not below, not after, but directly on that support or resistance price level. And then the reversal trend. So the indecision candle, when it sets up on price, on support or resistance, becomes crucial. Now, why does it need to be on a support or resistance area? Well, indecision candle and a bullish preceding trend indicates that buyers are possibly losing control, possibly. However, an indecision candle does not indicate that price will reverse with any degree of certainty. An indecision candle only indicates one thing. What's that? Indecision. So you can see that these indecision candles at any trading session appear quite often. Sometimes you can get 3 or 4 right next to each other too. Okay. And with our indecision candle strategy, we need that indecision candle directly on that support or resistance. Sometimes we can have 3 or 4 of them. But what we're looking for then, it becomes the reversal trend. The reversal trend is the third and the most important part of the reversal setup. This is where we make our profit. After a preceding trend stalls as support and indecision forms, you will often see a reversal trend. Okay. Now, this is the transition of power. Now, the thing is, there's no guarantee that the next candle isn't going to break right through and keep going up. There's no guarantee it's going to fall down below. So the crux becomes where to enter and how to execute the trade and where to put your stop loss. So it's all about getting in at the right time and minimizing your risk by having a very tight stop loss. So that way, if the trade moves against you, okay, in most cases, it never gets executed. But if it does, so in other words, if the indecision candle forms on the support and resistance, you can't wait for that next candle. You have to be, because that's where the profit's to be made. You have to trade as soon as that next candle forms and use your indecision candle for the low of your indecision candle or the high, depending on which side you're going, as your execution level, as your buy level. Okay. Your stop loss is set right near the swing low or the swing high of the preceding candle. And what can happen? Well, now that you have the setup, okay, there's only 2 possible scenarios. The next candle is going to continue up. Well, there's a whole bunch of little possibilities, but the next candle is going to continue up and continue that trend. Well, if it does that, what happened was your trade never got executed. So you never had a trade. So you lost nothing. Now, it could have dipped down enough that your trade got executed and then move up. Well, guess what? You get stopped out right away. So yes, you had a losing trade, but it was a small little loss. Or the third thing is it went in the direction you selected and you make a sizable amount of profit. Most of these trades never get executed. Some of them get stopped out, but the few that do make profit make you a nice, hefty amount of money to offset any of those losing trades. It's knowing where to execute it. So remember, failed trades happen. There's nothing you can do about them. But getting in at the right time lowers your percentage of failed trades. Many people wait for a candle close to get in, but I have tested this thoroughly, and waiting for the closes gets you in too late. So the first candle in the reversal trend closing far from the support. So what you want to do is, here we go as an example, bullish trend, indecision candle on your support and resistance. You use the wick of the candle, the swing high, to set your stop loss. You use the low of this candle to set your entry point. So when the next candle forms, which would start out here, if that candle, if the price moves this way, guess what? You never got executed because you were betting the price would go down here. It's very rare that it's going to open, swing down here, and then move back up here. But if it does, then you got executed down here, you got stopped out down here, and it's a very small stop and you lost. Or you got executed here and the candle moved down nicely and even did a retracement of 50% of its prior move. You made a nice little nest egg. So it's important where you set your triggers, where you set your entry trigger, and where you put your stop loss. It's just the reverse in coming off of a bearish movement. And you always have to calculate, because just placing a stop loss doesn't mean you can afford to make the trade. Without using proper risk management and calculating what your risk reward ratio would be to see if you can even execute that trade is good. So you would set your target at the opposite level, right below the next resistance or support zone, depending on which way you're going. Okay. And then calculate your stop loss rate, your risk reward ratio from here to here, and your risk ratio from here to here. And if it's not more than 2 to 1, you don't execute your trade. So that will also help you from getting in trouble and minimize the amount of trades you make, because you're not allowed, you can't actually make the trade. So I always start out with my trend line, then my support and resistance levels. Then I look at price action. Finally, I'll always look at volume to confirm. If volume doesn't peak, it doesn't confirm your trade and the movement in the direction you're expecting. If you don't see a peak, a jump in volume, don't execute your trade. So this is the starting point for you to think about, you to start building this into your own trading strategy. And this is a nice little easy setup. It's not overcomplicated. In no time at all, you can be employing it, but you need to learn it. You need to test it. You need to trade it. You need to make it yours. Because remember, your capital is always at risk. So do it on a demo platform or do it with small money until you get it down pat. Thank you very much for joining us and have a great trading night. Bye now.